Hello, everyone. Welcome to this webinar. Equity markets teach us lessons in every phase, and we have seen that in 2018-19. We are seeing that now. We have seen that always in the past. Many thought leaders, out here who have been coming here, have always reminded us that equity markets teach you old lessons in new ways, and hence, a fund manager who is flexible and is able to adapt to the new ways of equity markets is able to actually, give good returns. At present, equity market is kind of seeming to be confused between value and growth. We have been hearing various fund managers who have been talking only about growth and have been very casual about valuations. And their claim has been that valuation for growth businesses, do not matter. And beyond a point, it is the growth that matters. But at the same time, now we know that over last around 5 years, there have been many very good, growth businesses where valuations were obnoxious. Valuations have been very high, and investors actually have been invested into those businesses with a lot of conviction. But some of those businesses have actually fallen over last 6 to 8 months when FIs have been selling. Now, obviously, some of those businesses were darlings of equity markets have fallen by almost 20-25%. It makes the case all the more interesting and attractive for those companies because they are obviously, good businesses with great growth. But at the same time, there have been many other businesses where there is a value still, but their growth story is also intact. At the same time, they may not be the best business in the respective industry. So there is hence this tussle going on in the minds of investors whether they should pick some of these best consistent growth stories, or should they kind of understand where market is headed from the recent correction of these high value consistent growth businesses and try to navigate the future into equity markets with more fine strategy. We want to understand this in detail from a fund manager, Mr. Naveen Chandramohan, who also follows growth investing, but within that, he also very finely understands and executes the cash flow growth, which provides a cognizance of valuation as well. Hence, his philosophy is following growth at reasonable valuations. Let me also spend 30 seconds and tell you that the numbers for the month of May for the entire PMS industry are out, and almost every PMS has given negative return in the month of May, and returns range from around -4% to -10%, and many growth businesses, many growth focused, I would say, PMSs, which were less cognizant of valuations, have actually fallen around 10%. Obviously, this is the part and parcel of equity markets, and we are not trying to kind of create a fear around here. In fact, we want investors to always focus on a more positive aspect, which is returns and not the risk. But obviously, it is important to understand where market is headed, and that is where we thought of doing this detailed discussion on the way forward. That is why we have kept the topic as selection between growth and value. And is it a time where we can say that growth is down and value is coming back? Over to you, Naveen. Naveen has made actually a very interesting presentation, and warm welcome to you, Naveen, once again. And over to you. Once you give your presentation, and then we will do Q&A.
Sure. Thanks, Kamal, for setting the context to this conversation. And like you said, what I'll do is basically share a brief presentation. It's just a small set of slides that's been put together to set the context to our conversation. So, Kamal, you should be able to see the screen. Just confirm.
Just change this to a slideshow mode.
Sure. So obviously the world is going through a normalization stage today, right? What do I mean by normalization? I think the last 2 years has basically what it effectively did through excess liquidity was for people to chase businesses at any valuation. And unfortunately or fortunately, as humans, we look at confirmation bias around our decision making ability. So when you buy a business whose price keeps moving up, you tend to believe that you made the right decision. So you look at price as a confirmation bias to around your decision making ability. And that in general results in issues over time, especially when you are driven by a liquidity driven environment around what Fed did and around what global central banks did. So like you said, the topic was, is growth dead? and is value actually the way forward for things? So what I wanted to do was, unfortunately here, right, we've used growth and value in a very in a way which is interchangeable without understanding where it even came from. Now, because of US being the home of capitalism and having much longer history, the words actually value and growth have been borrowed from the US into the Indian context. So if you look back in 2011, right? So this was an article written back in 2011, where Google was actually called a value stock back then, right? And obviously today, in 2021, which was roughly around 1 year, if you rewind back, Google was in the middle of a very structural upturn over the last 7 years, and in the last 2 years, that was exacerbated because of liquidity as well as the growth coming in, right? So the same stock over a decade suddenly turned from value to growth. Now, through this, what actually happened to the business? Let's just look at it, right? Over the last 8 years, Google stock went up almost 5x. And that 5x came predominantly because of the actual revenue per share growing up 4x and some amount of re-rating in the stock. So why did you get consistency in shareholder returns in a stock like Google was predominantly because the valuation that you got as a minority shareholder came predominantly from fundamental earnings growth or cash flow growth rather than re-rating growth. And it's very important to understand the difference between the two, right? So when you basically talk about the so-called consistent businesses that keep going up every year after year, very rarely does one look back and ask, did this so-called IRR get generated because of cash flow growth, which is fundamentals, or second, because of market re-rating the businesses? When you have your cash flow growth structurally growing and valuation is not re-rating itself in a significant way, the possibility of you getting drawdowns north of, you spoke about 25% drawdowns, Kamal, most likely it's been 50 and 60% in most cases, right? So you will get into such scenarios when valuation is not being paid attention to. So let's just put this so-called 2 years into context, right? So what we have done here is, so the last 4 years has been a resurrection of the SaaS-based businesses or digital-based businesses. So we've basically taken businesses in the US and looked at the top quartile, bottom quartile, and the blue line is the median of all of these businesses. Total of around 450 SaaS-based businesses being allocated in the top quartile, bottom quartile, and the median. So look at what happened to the valuations. The average EV to sales multiple that US businesses, which were SaaS-based businesses, were trading at was between 5.5 to 7 pre-COVID. And with the infusion of liquidity, this basically shot up almost 3.5 times. So what you are seeing in terms of normalization of this is the valuations reverting back to mean, which is what generally happens to the markets. The same thing can be extrapolated to our Indian markets as well, where most of the businesses where you were willing to buy it at any valuation is now mean reverting because the situation has changed from a liquidity perspective. Right? So in the middle of the party, you obviously don't know when the party is going to end. And because of the fact that you feel good in the middle of a party, you wish it never ends. But unfortunately, life doesn't work that way, right? So now coming back to the Indian context, and here again, I want to give you a misnomer. So NSE, right? NSE actually has, it comes up with what is called smart beta indices. And there is, and I would urge investors to look up this index. You actually have passive indices in India, which replicates the value index of NSE. So what they do is they pick up the top 20 value components of Nifty 50. And interestingly enough, it outperforms Nifty over 4.5% over long periods of time. And if I was to actually, without telling you the constituents of the index, right, ask you, what would you guess as the weight of the financial services index, because if you are Kamal, you are close to the market, and many investors here are obviously investors in the market. And the big theme today is financial services offer huge amount of value. So if you look at any MF, any PMS, any AIF, there's a big weight towards financial services, right? And also tech is thought of as growth, right? So one question that I'm not going to answer, and we'll take it up in the Q&A. What do you think is the weight of the financial services index in the value component, and what is the weight of the tech in the value component? Hold that, and I'll come to it later, right? So just to basically think about what is happening, we are in a world where we are normalizing into a world of fundamentals. So how do we think about businesses? We don't think about businesses whether it is a growth business or a value business. We think about businesses from three lenses. A, is the business able to grow its market share? Is the business able to grow its cash flows? Is it reasonably priced? What is reasonably priced? So I'll just give you metrics, right? Many multiple businesses, multiple funds owned businesses with this kind of a flavor. Price to sales multiple was north of 10. The growth rate of the business was not more than 15%. And the competitive intensity in such businesses was fairly significant, right? So your PAT margin is not more than 10%. If that's the kind of businesses you own, it's very hard to justify these kind of valuations. So end of the day, what I would want to conclude before we go into Q&A, there are only three things that will ultimately matter to future returns. A, the investment that you make or the business that you own, does it have the ability to generate cash flows? Because if it does, you are entering a business which does not need to borrow significantly to grow. Incremental capital actually matters. How does the management or promoter think about it? Valuation is always an element of subjectivity. Fund manager A might tell you it is cheap, fund manager B might tell you it's expensive, and that is where a certain level of discretion comes. Otherwise, end of the day, all of our jobs will be taken over by systems, right? But there is a framework that you can always think about rather than saying that I will just buy because the price is going up. So if I was to put ITIS's own portfolio into these metrics, so if you look at it over the last 2.5 years, the consistent attribute that you would find in our portfolio is the return on incremental capital continues to expand. And even though the operating margins are slightly lower than what it was a year and a half back, it still has a significant, almost 2x the operating margin of Nifty, which basically tells you the pricing power of the businesses that you tend to own and a portfolio that we run. So I just wanted to end this conversation here from a presentation perspective, and then we can take this over more so from a Q&A.
Right, Naveen, it has been really, short and sweet presentation, which kind of points, some very meaningful aspects. So, the very first question which comes to my mind, and, investors generally ask this question, that what suddenly happened to the IT story? We did not see very high valuations in some of the well-known IT companies. The valuations, obviously, if compared to the last 3 years or 3-4 years ago valuations, they were high. But given that interest rates were also low, and we were in the in a scenario like COVID, where IT was considered to be a sector which was booming. And I remember in the February of 2022, just 4 months ago, when we did our annual summit, many thought leaders from the industry, they came and they kind of they maintained that IT as a sector should continue to do well. So if I ask them this question, what are the top three sectors? Two out of those top three sectors, which were common to all thought leaders, were financial services and IT. But suddenly now your view on financial services is different. And at the same time, IT stocks have fallen. I'm not wanting you to answer about financial services here in this question, but about IT. What is the view on IT? What has suddenly happened? Why stocks like TCS, when they have announced even a buyback at 4,500 around 3 months ago, stocks like Infosys, when they were kind of filled with orders and employees working there are actually getting high bonuses. So what is really happening? Why market is not giving thumbs up to IT at the moment?
Sure. So first, see, end of the day, valuation is always a narrative, right? Market works through the combination of two factors. One is the numbers stacking up, which is what you spoke about, where the numbers are beautifully stacking up for the IT sector at large. And second is the narrative, which changes from time to time. So the narrative back in 2020 was we were moving into a COVID driven world where digitization becomes the so called norm for every business. And that narrative has not changed, right? Now, in India, right, you have large cap IT, mid and small cap IT. Now, someone like an Infosys and a TCS consistently is showing almost a 3 to 3.2% QOQ growth on a conservative basis. You analyze it, it's almost 16 to 17%. Some of these mid and small cap IT companies are also showing maybe 4 to 4.2% QOQ growth. So a large cap is showing a annualized growth of 16 to 17%. A mid cap or a small cap maybe at best is giving you a 20 to 22% QOQ growth. Sorry, annualized growth, right? And look at where the market valued these two. Large cap was valued at a multiple of 22 to 23 1 year forward. Mid and small cap IT was valued at almost 70 to 90 times from a multiple perspective in many cases. So you are seeing some amount of normalization there. Now, why are we seeing this narrative change in the short term? For the first time, people are acknowledging that US is under a risk of recession. Now, in a recession, if you are running a company in the US, let's say you're running a Fortune 500 company in the US, right? There are two things that you would do. First thing is you would cut people. Second thing is you would cut IT spends. Many of these US companies have been running on at least 5 to 7 SaaS-based softwares over the last 3 years. It was a bull market, everything was good. You don't talk about IT spends rationalization. It's during periods of difficulties that the first thing that you go to is employee cuts because that's your operational leverage. Second thing that you do is, do I really need an IT spend? So the narrative has slowly changed. So while the order book that you saw, let's say Infosys saw $2 billion contracts for the first time in its history signed up, right? So they need to be very thankful for it because in the June quarter, I don't expect them to be signing the next $1 billion contract, right? Because companies are going to pull back. And that narrative has what has changed. And you are getting a small correction here. See, when I say small, I think 20 to 25% correction in an Infosys and a TCS is par for the course. Whereas what you revalued in the form of a structural 10-year story with small caps, there they are correcting a lot more significantly. So again, the narrative has changed in the short term. Market is basically punishing those where valuations were not paid attention to. And today now people are questioning, is IT structural or not? I think end of the day, my view continues to be IT deserves a place in your portfolio. Now you need to figure out where you want to go into. You want to go into large cap IT or you want to go to mid and small cap IT where you have much higher drawdowns, but which are those companies that can still structurally grow? That's the call that one needs to make.
And with the fear of US getting into recession, what are the other sectors then that you think should benefit out of it?
So end of the day, see, where this recession, if it does happen, right? I mean, technically, a recession is, you can think of it as a GDP contraction over 3 quarters, right? That's the simplest way to define recession, right? Because while we use these terminologies, just as we use growth and value liberally, we also use the word recession liberally. What is recession, right? When your GDP on a quarterly basis contracts over 3 quarters, you can say that structurally the economy could be under recession. And we are in the first stage of that. Let's see in the next 2 quarters. There is a risk that we could get because liquidity is getting sucked out of the system. Now, obviously, because of that, the pain is going to get filled by employees getting cut first. So, in the last 3 years, you would saw a lot of people filing for unemployment in the US. Why? Because the Fed was doling out $1,200 per month when you file for unemployment. A lot of these people were reinvesting that in the Robinhood and the Bitcoins of the world. And they were extrapolating their returns in an IRR for the next 10 years and saying, I'm set. Now, all that party is finished. So all of this needs to get rationalized and people need to come back into the labor force. And I feel that could be a 6 to 9 month phenomenon. Over the next 2 to 3 quarters, you will see supply demand rationalization. You're also seeing, so actual value in the US is three places, right? There is energy, there is metals and mining, and there is natural gas, right? Lot of this is doing really well. Unfortunately, in India, these are not sectors you can play structurally. What do I mean by that? When Warren Buffett buys Occidental Petroleum, he is actually buying a private company which is capitalistic in nature, whose PAT is going to grow up significantly because of where oil prices are. The equivalent of that in India is for us to buy ONGC. The government can easily go and cap prices, just as you saw around what they import. They put an import duty on steel. They can do that for sugar and ethanol. They can any monopolistic sector where you have government intervention in India, you will always look at it as value. But if you are not functioning in a capitalistic market, there's no point of that value being there. So that's where most of what you see in the US, you superimpose it to India, it really doesn't work. So value is in India is effectively, it has to be a combination of growth when you buy it at a reasonable price. That is what value to us means in India. So I think what could benefit in the short term are these businesses that are still showing growth, right? You have good specialty chemicals businesses that are showing margin expansion even during this quarter. You have B2B manufacturing businesses setting up capex. You have cable and wire businesses which are setting up capex with structural growth behind them. So there are pockets, and you still have IT. I still think so. I didn't answer that question, Kamal. The Nifty Value Top 50, Nifty 50 Top Value Top 20 Index has 42% exposure to IT today, right? So there you go. You have value in IT. If you think that is value, you should be buying IT. And I asked you to guess the weight of financial services. Can you make a guess?
50.
The answer is zero. It's there for everyone to see. I'm not making these numbers up. This is basically NSE publishing this index, and you have Nippon and you have two other AMCs giving you passive opportunities on this. So people need to understand what value is, what growth is, and then take a call how to position themselves. So if you're talking about IT, yes, there is value here for sure.
Right. So in detail, would you want to elaborate, what are your views on financial services? Because financial services is a sector which is heavy in all indices, is heavy in all top mutual funds and top PMSs also. And any fund manager and thought leader comes out and says the top sector is financial services because they want to obviously, try and outperform the index. Hence, they have to first hug the index. So weights of financial services, all of us understand, is around 40% Nifty 50, around 30% Nifty 500. So it's a very important sector. But I would like to hear out your views in current times over, say, next couple of years.
So I think end of the day, we own financial services, but we are the least overweight financial services since inception of the fund. And when I say inception of the fund, it's been 5.5 years. So it's not like I don't own financial services. We own two private sector banks, but our weights have come down significantly. And we started trimming all the way from August to now September 2021. So it's been a while that we've been underweight. Right? There is value in it because when you see HDFC Bank available to you at a 2.5 times price to book, that's your median multiple for the last 11 years. But it is value because there are some issues that the bank needs to deal with, right? So one needs to price for issues. You're not going to get growth at a sensible price unless and until there are some headwinds behind it. So then you're betting on the management to do the right things to overcome it. Right? If Google was called value in 2011, you need to go back to Google and see why people didn't invest in Google. Today, everyone wants to rush behind Google, right? So, end of the day, it was not like Google was a bad business, right? But there were headwinds for Google back then. People just forget it with the 10-year history behind it. So, our view continues to be there are better places. So, that's the advantage of running one fund, Kamal. It's both an advantage and a disadvantage. I'm not looking at investing in all the sectors and running 10 funds around it. I'm investing in one fund and looking at constructing the best 18 to 20 businesses that offer growth to me at a sensible price. Do I find financial services to get overweight today? The answer is no. I think there are better pockets for us to get invested in. But if you are running 10 separate funds, then one fund has to be overweight financial services. So I guess it also boils down to, it's not a question of what fund managers need to do or how they think about it. It's a question of what are they actually running behind each strategy of theirs.
So talking about value conscious markets at present, in that context, do you see any new age business, similar to where, as you mentioned, Google was in 2011 as a value stock or a value business? Obviously, it was difficult for all of us to comprehend value getting translated into growth 10 years ago, 11 years ago. But today, you are a new age fund manager. I want to understand from you, do you see any new age business today which over, say, one decade can translate into a growth, maybe not similar like Google, but in similar terms, which today is a value play? It is difficult for us to comprehend that. But you, as a new age fund manager, based on your learnings, based on your exposure and experience, would want to talk about it.
So, Kamal, just to clarify and set the context, right? I don't believe businesses are new age and old age, right? Businesses are meant to do only three things. A, they are meant to generate cash flows. B, they are meant to reinvest those cash flows, which is what the job of the management or the promoter is. And C, when you get these two characteristics, the job of investors like us is to see are they available at a reasonable valuation, right? That's it. So the concept of new age and old age is again a jargon that we like to use because these are new listings, but that's not how we look at things. Again, I don't think any of these businesses have value from a valuation perspective. They're all expensive, right? None of these businesses. So, for example, you are aware we own Nika, right? And I don't think Nika is cheap by any stretch of the imagination. The only way I will manage my downside on such a business is the exposure will be much smaller than normal, right? That's the only way, by basically saying that if I am wrong, then the portfolio NAV drawdown that I cause should be limited. The only way I do that is by position sizing. So I don't think beyond this, QSR is an interesting space to us. You have a business that has been operating in India for almost 20 years. So I'm not talking about some of the new listings. I wouldn't look at them at all. You still have good quality QSR businesses that have been running in India for the last 20 years now, which are worth looking at. I wouldn't call them cheap, but they are more reasonable today versus what you had year and a half to two back, right, over the last 2 years. So I always think the simple way to think about it is forget what happened in COVID. Think of 2 years as it was a dream that was given to you by central banks that is getting pulled back. Now, renormalize yourself into a pre COVID world and think about growth and value your businesses. And then think about, does it make sense to own the business? I think the common mistake that we tend to make is, oh, 8 months back, the business has fallen 50%. That means I'm getting it cheap. 8 months back, you were never meant to be there, right? That was a dream that was given to you that is being pulled out. That's not coming back. So renormalize yourself into, let's call it deck 19. How was the growth rate of your business versus where it is today? What was the valuation back then? And then rebase it off that rather than thinking about it 8 months back and saying, I have fallen 60%, so I'm getting the business cheap. I think that's a dangerous way to look at it today.
So just to give a context to what Naveen is saying, and again, this is a further question to you, Naveen, is that today there are businesses like Titan, businesses like Asian Paints, which have fallen maybe 25 to 30% over last 6 to 8 months, and we have been hearing a lot of new age fund managers and many other fund managers also time and again saying that these are some of the best businesses, and whenever these businesses fall by say 25% and more, it is an opportunity to invest in these businesses. So today we see Asian Paints fallen from 3,500 to almost 25, 2,600. Bajaj Finance is also kind of fallen similarly 25%. And there are many such examples. So anybody, obviously most large investors would be holding some of these businesses already. like all fund managers hold. But is it a time to actually add more of these businesses, or if you are not owning these businesses, you are a first time investor, should one see this as an opportunity, or one you see this market giving a signal of something bigger coming towards these businesses, because despite fall, these businesses are still high in terms of price to earning multiple, which many fund managers have been saying doesn't matter at all. Price to earning multiple conveys nothing, right? So I want to understand, because we understand even Asian Paints today maybe P is above 80, Titan also above 80, and many other businesses P is above say 50, 60. And at the same time, there are many other growth businesses where P is around say 25 to say 35. So obviously those are some of the businesses which we find in real estate sector, some of the less owned sectors. But what are your views in this regards, from 3 year perspective? And just a disclaimer to everybody, we may be talking about few stocks. It is not to be construed as any kind of an advice. It is just a matter of understanding by taking an example. Over to you, Naveen.
Sure, Kamal. So, Kamal, for us as a running a fund, uh, loss of capital is just not because the stock price falls. Loss of capital is also because over the next 2 to 3 years, you might not generate any returns on the stock. What do I mean by this, right? So let's assume that a business is giving you an earnings of 100 rupees today. You're giving a multiple on it. Let's say you're giving an 80 multiple on it, as a result of which the stock price is at 80,000. Okay, sorry, 8,000. Right now, over the next 3 years, this 100, if the business grows well, can compound at, let's say, 20% for simplicity's sake. So your 100, your earnings will go north of 160. So compounding will be slightly higher than 160. Let's just take for simplicity's sake 160. So 160, and your stock price need not have moved at all, right? Your multiple can still be 50. So you can say I have bought a great business which is growing at 20%, which would be among your top decile of companies in India, but you need not have made any money as a result of it. Right? So just because, I'm not saying you cannot earn money because you buy a high PE stock. End of the day, that has to be rationalized by also saying how well the management is reinvesting that capital and what is the competitive intensity in that landscape. So the stocks that you spoke about, they are great businesses. Do we own them, or are we considering owning them today? The answer is no. Right? We still think that there is not much margin of safety at the valuations at which these businesses are being offered. Now, it doesn't mean that another fund manager believes that these are cheap, because he might think that the growth rate is not 20 but 30. Now, whether the 30 is achievable or not is up to their discretion. In our mind, for an Asian Paints, which has given you a cash flow growth of 14% in the last decade, but has given you a share price IRR of 23%, well, I'm just questioning, where did that extra 8% IRR come from? It came from PE rating. So do I want to basically pay up to own that kind of a business? Though it's a fabulous business, my answer is no. Someone else's answer can be yes.
Like in last 3 years, we know specialty chemicals as a sector came out from the lower weighted sectors, and obviously those fund managers who were able to understand what is happening in specialty chemicals made maximum wealth. And we know some of the fund managers who were focusing on manufacturing and B2B businesses, they were able to kind of tap this opportunity. Likewise, in this decade, which many companies today call as a golden decade for India as an economy, what are the new sectors beyond financial services, beyond IT, beyond pharma, which you see are an opportunity, and from the point of view of value, they are kind of interesting stories, and equity markets are expected to give thumbs up.
So, Kamal, there are two ways to make 100x, and which is what every investor wants in his journey, right? The first way is to enter at a time where valuations are extremely depressed, but at the same time, it is extremely discomforting. So, what you are talking about is, I have to rewind back into 2013. If I was to give you the scenario of 2013, it is extremely uncomfortable for investors. right? For the first time, INR was crossing 68. For the first time, there was huge outflows. There was an election risk. There was uncertainty. There was inflation. There was Greek crisis globally. It was a mess. So valuations were cheap, depressed across the board. Hence, you could find a sector, right? I'm not talking about a company. You are asking for a sector which was depressed, right? And then you find good companies within that sector, and you could make 100x over the last 7 years if you had the gumption to hold it. Today, you're not having that kind of your interest rates have come down. They've normalized into more sensible territory. Valuations have gone up. There is no sector which is depressed. The only sector that is cheap is auto. And auto is cheap because there is no growth for the last 5 years, right? So, end of the day, for you to make 100x in a sector means you need to get in at extremely depressed valuations. Think about COVID. Think about 2013. We are not there. So the only other way to make 100x is to hold a stock for more than 20 years. Right? So that means you need to give the benefit of business a time to a business. So when you are talking about leave pharma out, leave chemicals out, leave financial services out, leave IT out, I don't know what is left. Then you need to talk about businesses. There are good businesses that have the ability to grow capital, but at the same time, investing is not about buying a business and forgetting about it for the next 10 years, because your managements change, promoters could change their capital allocation. So end of the day, your view has to be evolving over time, right? So when people tell me that they run buy and hold strategies, it doesn't make any sense to me, right? There has to be some amount of churn. Hopefully it is low, right? In our strategy, we've seen around 20% churn. So I think some of the businesses that we own, obviously we are biased towards, and we think that these could be significant compounding machines over time. But then it's a question of seeing, does the management stay true to its course? And the same thing, right? 2 years back, IT was structural. It was meant to give you 10x in 3 years. Suddenly everyone's narrative has shifted. So the question is not what can give you. The question is, how do you react when the narrative changes? And which are those businesses that can still give you those value? There are only 3 to 5 chemical businesses that have compounded significantly. Others have given, most of them are out. Many of them don't hold. Business is going to give you structural returns.
Sure. So, the second way of making 100x that you mentioned, where you mentioned that the second alternative to make higher returns, multi-bagger returns, is to own equity as an asset class for, say, more than 20 years. So doesn't that favor some of the stocks like Asian Paints, Bajaj Finance, HDFC Bank, because these are considered to be companies which will survive, say, after 10 years from now also, because they have moated businesses. And though today they are highly priced businesses, and maybe you are not liking them because it doesn't kind of give you valuation comfort or margin of safety that you mentioned. But going by the answer that you gave to the last question, where you kind of are not finding value in any sector like we saw in 2013, and at the same time, to make highest possible return, one needs to own business for long term.
Absolutely, right? So then it goes back to, so the beauty about making such generic statements is such, see, in life, right, when you make a statement like this, or even if I say you need to hold a business for 10 years, I need to back it up with data, right? Now, if I'm going to tell you that own HDFC Bank for next 20 years, today HDFC's market cap roughly is worth what? I mean, maybe $100 billion, and maybe an Asian Paints would be around $50 billion. Am I basically saying that in the next 20 years, $100 billion is going to be worth $2 trillion or $3 trillion? I think effectively that is we are talking about India's market cap going from $3 to $5 trillion, right? Or $3 to $6 trillion. So out of the $6 trillion, one company's market cap being 50% of it. What is the probability you give for that to happen? And that's your answer right there.
So we're talking about 20 years, India's GDP will not be 6 trillion. It could be maybe, we are talking about it turning from 3 to 6 in next 5 to 6 years. Not in 20 years.
20 years, you can choose a number, Kamal. Maybe it's 12, 13, I don't know. You
Yeah.
want to say, so end of the day, see, I mean, we are going into a territory that both you and me can't comment about, right? We can just make probabilistic, realistic guesses around what could this happen. But still, you're talking about one or two companies becoming 40% of India's market cap. Do I want to bet on the fact that this is how it's going to evolve? My honest answer is I think there are better businesses to bet on from a valuation perspective, not from a quality perspective. I still think HDFC Bank is the best, one of the best in the country, even though they have certain problems that they are going through today, right? That doesn't mean the best business doesn't mean that I will get the best returns. I keep going back to this example, right? Microsoft has always been one of the best businesses from a distribution perspective. But for a good part of 11 years, it gave zero returns, right? So, end of the day, it's not like you just forget, you hold on to a business and you forget about it and you will make money. That was at a time where capital was scarce. 20 years back, the access to capital to India was extremely limited. So you had small businesses becoming extremely scaled up businesses, and you had great promoters do that. Today, think about diagnostics, Kamal, right? You had two large diagnostics players generating a return on capital of 44%, and you see what happens to competition. I'm not saying that is justified, but I'm just saying that when capital is available, competitive intensity will intensify. The same thing is happening in paints as well. So India 20 years back, buy and hold worked. India 20 years hence, the capital and the liquidity situation is very different. So buy, hold, and forget, I'm not sure is the right way to do it. But if someone wants to do it, then you have passive strategies to do that as well, right? So then the question is, what appeals to an investor? Then the investor should not be reacting to Fed, inflation, noise, all of this. They should just zoom out and basically say 20 years, I'm not interested in talking to anyone about the equity markets. If they are willing to do that, then sure.
So currently, in 2022, obviously we are in relatively uncertain times. The equity markets are always surrounded by some kind of uncertainty and some kind of risks. So based on your 2 decades of experience, can you compare the current times with any time in the past in terms of how much, more correction could happen, or because history teaches us, if you could kind of correlate to any past phase of equity markets, that will give a perspective to investors in terms of opportunity and challenges currently in the equity markets.
So rather than just correlating to time, right? I mean, when you'll have to correlate to certain behavioral aspects. So the way we think about it internally is obviously you are entering into a time where liquidity is becoming scarce. When liquidity is becoming scarce, you have real issues on the demand side with that has to normalize to the supply side. What does that mean? So for example, you're already in the early stages of companies letting go of employees, right? And if the issue is all of the disruptions that you had has been on the supply side, the demand side still has been relatively robust. So if the supply and the demand normalizes over the course of the next 2 to 3 quarters, I think growth will take over. So effectively, what do I want to see? I would see that from the US, there could be another 10 to 15% downside from here. Where will that emanate from? That can emanate from additional Fed being a lot more tighter than what you expect. A lot of companies actually letting go of employees, and as a result of which wage inflation actually normalizes. Some amount of supply chain issues that we are facing, that normalizing, as a result of which the liquidity kind of creates a supply demand mismatch that what we have today, that kind of rebalances itself. Now, I don't look at this saying that this is a crisis that we are in. It's not like we are in a 2000 like scenario or a 2008 like scenario. Far from it. I still think we are in a normalization driven world. And I think that would take another 2 to 3 quarters the way I look at it. And within that, any volatility that you get, we would use that to deploy capital. That's how we're thinking about it internally.
There is a quote by Mr. John Templeton, I'll just remind you that, which says that the 4 most scary words in equity markets are when people start to believe but this time is different. This time is different. I'm sure you would have heard about it. So how do you kind of want to comment on this quote in the current context?
I mean, it's see, end of the day, the markets always rhyme. Have we faced something similar before? I think we've faced environments of easy liquidity before. Environments of easy liquidity make us react in a certain way and extrapolate our returns for the future. So the market always oscillates between fear and greed. Last year, there was an element of greed that had crept in. Today, we are in the early stages of fear that has crept in. And many people are questioning what can the returns be over the next year, and how should I think about equities, because no one likes to deal with volatility. So it's never different. It's always, as long as humans are involved in the market, the reactions are going to be very, very similar, right? So it's not like this market is different. It's just that the sectors, the businesses that are in favor at any point of time is always slightly different from what you see in a previous cycle. Like 1.5 years back, pharma was the darling. Today, no one wants to touch pharma. Same thing that you can extend towards IT, right? Now everyone wants to get into metals and energy because there is a structural uptick that people are seeing. But when you rewind back and you realize that these are more cyclical businesses, it is not a guarantee that you're going to make returns in these kind of businesses. You are going to see 30-40% drawdowns like you are seeing today, right? So end of the day, it's never different. It's always, history always rhymes in different forms in the markets.
So talking about positives, because it is important to learn lessons from what happened 3 years ago. In the deep pessimistic times like COVID, where everybody was thinking that this time is actually different, market recovered from ashes, and those investors who were brave enough to understand markets from the perspective of valuations or equities from the perspective of valuations, very rare, very few of them actually kind of boldly invested and made money. Today, in the current context, where again, many investors may be thinking this time is different, but reminding them of the positive side, what could actually turn out to be positive outcome of whatever pessimism and negativity we are seeing around us. As a positive fund manager or as an optimistic fund manager with a long-term view, what are your wise thoughts in this regards?
I think there are a lot of positives, Kamal. End of the day, if you think about who has been the biggest beneficiary of this supply chain disruption that we are going through, and even today you're hearing that Shanghai might go into additional lockdowns again because of this cases spreading. Who do you think is the biggest beneficiary? Even though we are not the most efficient, India is the biggest beneficiary, right? Supply chains have moved into India in an aggressive way. Production capacity has moved into India in an aggressive way. So I still believe that from a growth story perspective, there are multiple businesses that are having tailwinds that they've never had in the last 20 years. And you will see the benefit of that in. So, what I say is, today, while you have discomfort, the investments that you are making are for next year's returns. So rather than thinking about it, saying, if I invest today, what will be my this year's returns? I would urge investors to think, if you're investing today, it's most likely going to be for next year's returns. And it goes back to the fundamentals around how you are stock picking in this environment, right? So periods of maximum discomfort is when investing becomes that much more lucrative. Periods of maximum ease, where you feel that there is no risk to talk about, is when your 1 year forward returns are going to be muted. So that's the way I would think about it. So from an optimism perspective, I think there is a lot to be optimistic about.
So, so given the around 12% correction that we have seen from peak of equity markets, I don't think we are in a phase where we can say it is very painful phase for us to actually kind of think of this as an opportunity, because in the past, over last more than 40 years of history of equity markets, markets have normally corrected around 10 to 12%, but the corrections beyond 15% or maybe even beyond 25% are the phases where, if one entered in those phases, has actually made good returns. So in that regards, I was trying to ask you that question that, if you can correlate to any past phase and give a perspective, is the correction done? Is it underdone? Is it overdone? So that obviously, everybody knows that timing equity market is impossible. But still, putting yourself in investor's shoe, you have 100 rupees to be invested, you will definitely think of understanding from the timing perspective. So this is, very important question. It may be a silly question, but still, as a fund manager, as a human being, putting yourself to investor's shoe, what is your honest answer?
So the way I think about it is the following, right? I think we are in the second stage maybe of a correction, if you think about it as a three-stage correction process. But at the same time, I as much as anyone else, I don't know where the bottom is or if we've already hit the bottom. All I can do is to ensure that good quality businesses, while you say markets are down only 12%, many of the good businesses are down 25 to 40% in many cases, right? And some businesses haven't shown too much correction at all because they continuously expand their margins and they don't operate in a very competitive intensity based environment. So you have the ability to buy businesses that have corrected, also the businesses that are expanding their margins. So I would deploy capital into any volatility that I get, right? So that's how I think about it. I cannot time to the bottom tick, nor do I know when it is going to happen. All I can, the way from a framework perspective, I think about the next 1 to 3 quarters is I don't think it is going to be easy. It is going to be volatile. But am I going to be deploying capital today? The answer is yes. Because I'm not looking at saying that, okay, next 10% and we are done, or next 15% or we are done, or we've already hit the bottom. End of the day, I'm not thinking about the market. I'm thinking about individual businesses. And as long as we get the right businesses at a sensible price, and we are getting them from as far as reasonable valuation is concerned, I would be buying them.
So at present, on one side, we see that FIIs have done very massive selling in terms of value over last 8 months. But at the same time, despite that very heavy selling done by FIIs, markets have not fallen much. It's only a 12% correction, and that too from very high levels of valuations. And it is a corrective phase, which is a positive phase where prices are kind of correcting to right levels. So obviously this is till now. Maybe this is what you mentioned as second stage of correction till now. So in the third stage of correction, what do you feel? Will this be DII driven or will it be FII driven? If we have to see correction primarily driven from the perspective of more sellers and less buyers, it could be for any reasons. It could be macro reasons, it could be uncertainty, it could be kind of investors becoming impatient. But based on your experience, based on your learnings, the third stage of correction, if at all will come, how will FIIs and DIIs behave in that regards?
See, generally, if what I'm saying is true and we do get into a third stage of correction driven by the US, it will be panic selling. So, end of the day, while you say 12% has corrected in India, if you look at US from peak to trough, it's again, if you look at S&P, it's again another 10%. But that doesn't mean some of these growth stocks have not corrected 70 to 80%. So there's a lot of pain underneath that 10% that you're talking about, be it in India, more so in the US, right? So the third stage of correction is where everyone throws in the towel, right? And I don't think so. We are there yet. What can we get there? We'll have to see, right? But end of the day, over the next 1 to 3 quarters, it doesn't make sense for anyone to be extremely aggressive. What it makes sense is to focus on fundamentals. Rather than asking the question of what the market is going to do, the more appropriate question is going to be what are the businesses that I would want to buy and which are the businesses that have pricing power for me to buy, right? And you're not going to get them at the bottom tick. As long as you own them because of the fact that they have corrected and they are sensible and it makes sense for you, because if you're going to be managing your own money, there has to be a thesis behind investing. You cannot say I'll invest in Asian Paints a year back because it was a monopolistic business, but today 30% lower, you're going to say that, oh my God, it was never monopolistic, the valuation was too high. Then the story that you have made for yourself is inconsistent. So as long as you understand the business that you own, you should be able to own it through a 20% drawdown. If the conviction was never there, then there is a problem. So that's more important than talking about, is the market going to fall another 10 or 15%?
Absolutely. Thank you so much, Naveen. I will just sum it up. Today, we know that there are various, businesses which are available at attractive valuations, and they are all hidden in the context of only 12% correction. I was trying to ask all these questions from investors' perspective, though market may look to be having corrected by just 12% or 10 to 12%, but there are many quality businesses which are available at right valuations, and they ought to be seen from that different lens. And that different lens is basically a lens where investors give significance more to returns and less to risk, because equity as an asset class is meant to be an asset class where risk is to be accepted. And if focus is on returns, only then one can kind of see these times as opportune times. Secondly, there are many growth businesses where valuations, equity markets were kind of ignoring. But in the phase where liquidity is drying, markets will become narrow, and hence, obviously, valuations will matter. So investors need to be cognizant of the same. So growth is important, but at the same time, valuation is also important. Buying and holding a stock for long, which we have been kind of hearing over last 3 4 years, is something which is again being questioned by equity markets, and hence being an active manager is also very important. You need to be cognizant of the same. At the same time, because competition is also rising, liquidity is drying, environment is becoming conducive to disruption every year. That is where obviously holding on to a business forever is something which is absolutely not something which will give best possible returns. It may give fine returns, but not the best possible returns. And lastly, given the current phase of equity markets, what we have learned from this webinar is that investors need to be patient, investors need not be aggressive, and a staggered way of investing, seeing these times as opportune times, not aggressively but cautiously, is something which we are concluding this webinar with. Thank you so much, Naveen, for your time, and thank you everyone for logging in.
Thanks a lot, Kamal. Appreciate everyone coming and giving their time here.